Well, good evening, everyone. Michelle Boyce with Rosenzweig Financial Services. Thank you for joining us tonight. I'm going to be your moderator this evening for our September webinar. Before we get started and I introduce you to our two speakers, just a quick housekeeping items. First, we are recording this tonight. So if you are here live with us, it's being recorded live. If you're getting the recording, well, then we're glad that you were able to listen. We are going to have a question and answer section at the end, but if any time throughout the presentation that you have questions, you can utilize the chat feature or the Q&A in the taskbar, and I will be monitoring that and be able to answer those questions. At the end, there's a raise hand function that if you click that, you can go off mute and ask a question. All right, so that is our housekeeping for this evening. Now let's get started with our main event, all right? So tonight's webinar is a very special webinar. It's kind of different than the others that we've done up to this point. So tonight you're going to hear from both Mickey Rosenzweig, founder and president of Rosenzweig Financial Services, as well as Greg Abella, CEO and the managing partner of Investment Partners Asset Management, or as we affectionately call them, IPAM. So you see them both on the screen. By now you've likely seen our communication announcing that RFS has launched a strategic partnership with IPAM, which brings their ability to create custom wealth management portfolios to our RFS clients. All right, so before Greg talks really about kind of IPAM's strategy, and their investment philosophy, and give a little bit of update on the market, we thought it'd be beneficial to start the conversation tonight hearing from both Mickey and Greg on how the strategic partnership came about. So Mickey, I would like to kind of start with you. You've started RFS over 5 decades ago, and you've been helping clients with a variety of needs from insurance, employee benefits, estate planning, just to name a few, ever since. Now, some of those long-term clients that are on the call might be wondering, why now, right? Why at this point in your career did you decide to take on a strategic partnership with a wealth management firm?
Thank you, Michelle, and good evening, everybody. Look, we've been doing this for a long time, and the focus of the firm centered around insurance, as Michelle said, employee benefits, pension design and administration, and estate planning, and with an emphasis on high client retention. And that's accomplished by providing competitive product, knowledge, service, and being highly responsive. And what we've experienced for many years is many clients have come to us saying, well, why can't you help us with our financial planning, our investment management? We have money in a qualified plan. We have an insurance trust. We have a regular trust. We have a personal account. And we always shied away from that because it wasn't our core competence. And it goes back to the philosophy of high client retention. We don't want to compete where we don't excel. So finally, after many years of being asked this question, we convened a search over several years. And I went to people that I knew in the investment business for many, many years, and got referred to Greg Abella several years ago. And that started a multi-year, I'd say, courtship, where he and I convened initially by ourselves in both New York, Philadelphia, Florida, over a period of time to get to know each other. He'd been referred by another firm that had just sold out to a big roll-up company in the investment space for many years. And the philosophy of Greg's firm, which is a second-generation investment management firm that his father founded, I think, in like 1988, or Greg will correct me later. And their philosophies are very similar. Competitive product, the same buzzwords, high client retention. So that started the process and the evolution. And then we went through due diligence, brought both firms together. We spent time at the Penn Club in New York. Some flew up for it. And we went through a whole process with lawyers, investment departments to come together and create this relationship, which we think will be very beneficial for both our clients and people that we know and their clients. And what's come from that is it's essentially they are now the resource for our clients who have a need and a desire for investment management and financial planning. And we're now providing the same resource to Greg's firm, IPAM, and they have clients all around the country as we do. So that's kind of the basis, Michelle, for the why. It took a long time to make the decision. We believe that IPAM is the right firm to partner with, and we've seen it so far that their philosophy is very similar as ours.
Well, that was going to be another question, right? So that was going to be the follow-up question of kind of why IPAM, but you covered that, so it's a similar philosophy, that high client touch, high client retention, always putting the client at the center. So thank you for sharing that, Mickey. So Greg, I'm going to kind of switch this a little bit because, Mickey just kind of spoke from the RFS side, but, he touched on it a bit. But now it's really a two-way street with this partnership. And now, us at RFS can be a resource to your clients for their insurance needs. So why don't you, from your perspective, give us a little insight on what made you want to engage, with a relationship with RFS?
Thanks, Michelle. And thanks, Mickey. I think that was very well said. And this is not a decision that was made overnight on our end either. We are very much a highly disciplined firm, and we've stuck to our knitting in investment management. We've really not ventured into other areas, although the client needs over time have developed and become more robust. I would say that people that want to have their accounts managed now suddenly want financial planning, which we've added over time, and they want different bells and whistles. And the more complicated an estate plan or an estate gets, the more the need for insurance products comes into play to button off all kinds of risks that can exist. And so over time, we've had relationships with different firms. We've referred something out or referred to one firm or another, and people leave, or the philosophy of one firm changes over time. So we were looking for something consistent and repeatable, and high touch, the same way that we are. And so as I got to know Mickey and subsequently Michelle and Stuart and Mark, I was just very impressed. And as we met at least one time in New York, as we were walking out, our team was like, boy, they're just like us. And that hit home. And so we are very comfortable that if we have something that's high priority for our clients, that doesn't have to do with investment management, but is right in RFS's wheelhouse, that they're going to be taken care of promptly, the best possible service and follow-up and all of those other bells and whistles that are so important in client retention, satisfaction, and and candidly just my own pride of what we've built. I just want to make sure that we're well represented no matter what we do, whether it has to do directly with us or otherwise.
So Greg, just a question. Clearly, if you bring our firm into one of your client needs, it does create more risk to your firm to retain the client. And we experience the same because the more services you offer a client, the greater the risk of retention. Because if somebody does a bad job, it's a reflection on the firm. So how did you come to grips with that question? And I'll answer myself after.
Yeah, that's a good question. Well, fortunately, as we've forged this relationship, we've also seen you in action. And we've had a couple of engagements already where we've thrown something over the transom, and we've been very satisfied. The clients have been happy. We've been pleased with the follow-up and the feedback, and it's sort of reinforced that the initial feeling of simpatico that we were going to fit with our culture, that's already sort of borne fruit. So there's been more than it's what they call proof of concept has already been passed. So but I think that would be the best way to answer it, is that, like, I'm pleased with what I've seen already so far, and
It's
maybe you
like
can answer it.
it's like I'm happily married for a very long time, and sometimes when you meet your mate, whoever your soulmate, it doesn't always work out. And our firm is saying, I would say, everybody that we brought to you, client and internal firm, have been highly impressed with your team, you and everyone near you. So I agree with you on that point.
Thanks.
Okay, Michelle.
So Mickey's analogy is you're stuck with us, Greg.
I'm cool with it. You know, it really has been a great fit, and I'm so pleased, and that I hope that this relationship only grows over time.
Yes. Well, I think what you both said, you said the same things. You might have said them in a different way, but you said the same things, right? It really boils down to what's that internal culture, right? And that lines up for both firms. And we want to be able to provide the best services to our clients. And we're able to do that now on many different fronts. So now that we're kind of talking a little bit about, investment services. So Greg, why don't we kind of shift and you start to give some insight a little bit on what's IPAM's, investing philosophy. And when you work with clients, walk us through like what that process looks like and what is different between working with you and IPAM versus maybe where they're at now with like a different brokerage house.
Okay, that's great. So is this where we put the slides up, or
Yes, so let
okay,
me bring
great.
that up. I apologize, it got stuck behind there.
Not at all.
No.
I've got nothing but time.
All right, then let me make this a little bit bigger so no one is squinting. All right.
Perfect. So we are big believers in highly diversified portfolios for a lot of reasons. One of them is that from my own background as an insurance guy and a risk management guy in my former career before I started in investments. Um, I like to take portfolio risk and then manage that risk where I can to smooth out the return as best as possible, and try to get a long-term objective accomplished for a client with the least amount of volatility. And particularly as we're seeing right now, like 2 weeks ago, the market is, got zonked, and then the last 2 weeks it's gone way up, and that creates a very sawtoothed return for clients over time. What we're trying to do is a lot what institutional funds, pensions and endowments do, which is to diversify in a lot of different strategies that don't all correlate one to the other. So while we may have some asset classes that everybody is very familiar with, US large cap stocks, mid cap stocks, bonds, we round those strategies out with other strategies, other um, asset classes within a portfolio that might be high yield or commodities or alternative strategies. And the reason to add those, if you go to the next slide, is that they're not all correlated one-to-one with the stock market. So if I'm trying to build out a portfolio that dovetails with a plan that Michelle or Mickey or Stuart are putting together for somebody, what I'm trying to do is build out something that I think has a level of, there's no way to predict the markets, but and get it right every time, but it has sort of a reliability factor of, has this worked in the past, and what's been the experience in terms of volatility and return, and what's been the experience in terms of correlation. So if I add different strategies, the bottom blue line is just all cap US stocks. Let's just call that the stock market. If I add some of these other strategies that are in green or sort of pink purple here, I can modulate the return somewhat and hopefully smooth it out so that if you're planning something in the future, you're doing so without that sawtoothed experience that can come from just being in stocks and maybe having some traditional core fixed income bonds in it. That's
right?
us.
So
That's our strategy in a nutshell.
so the word I heard a lot there was correlation, right?
Yeah.
So, and I think we use that word all the time, right? We're very familiar with that, what that means for people. But I like to kind of maybe give like a visual and correct me here, So correlation, we want things, it's almost like a seesaw, right? So if if they're not highly correlated, right? When one's high, one would be low, right?
That's
Is
right.
that a good analogy? Kind of thinking like a seesaw.
That's right. So, and if you build out enough asset classes in a portfolio, and you include, say, commodities and real estate along with your equities, those asset classes don't tend to move in lockstep with one another over time. So by including them, if your equities might be going down, some other asset class might be going up or not going down as much. And if you get the model right, and we're building our 2025 model now based on how different asset classes have already performed. If you do that right, as we do for our as the same way that we build out a portfolio for very sophisticated institutions, we then apply the same discipline for high net worth individuals. And we've been very pleased, and so have the clients been, I believe, with the long-term outcomes.
Right.
We also
So
get more income from the strategies that we generate by doing it this way, because we're big believers in having income be a part of that total return. So that comes from dividends, it comes from interest, it comes from different cash flows that come off of some of these strategies, particularly like infrastructure, which has um, hydroelectric plants with utilities and uh, other energy related assets that aren't exactly like bonds and they're not exactly like stocks, but they provide high income.
So Greg,
Yes, sir.
will this add more risk to the portfolio? Less risk or the same?
Our effort in doing this is to mitigate risk and to dampen volatility over time, to try to eke out a similar return that you might get from a traditional 60/40 or 70/30 portfolio of stocks versus traditional bonds, but have it achieve a similar or long-term result, but with lower volatility.
Is your liquidity change along the way?
It can, it depends on the client. There are strategies that we include when appropriate, that might be either private equity or private credit. We don't go nuts and make that the entirety of a portfolio, because you really can't or shouldn't. But where appropriate, by adding those strategies, sometimes you add to long-term performance and long-term and ongoing income, and that they tend to help in that smooth result over the long term.
So in your fact finding, if I were to say, I've got $1 to invest, but I need it in a couple of years for income, for retirement, let's say, that may impact the decision process you make in the allocation. Or if I'm younger, saying, I got a 20-year horizon, I'm not going to touch the money, in theory, qualified plan money, then liquidity may not be as critical every minute for every dollar.
It has a lot to do. There are other factors too, like
Sure.
how much money does the client make? How much do they have in assets? Because some of these strategies are not they're restricted by the size of the client or the income that the client might have. But where appropriate, these strategies are really a boon, and we're big believers in including alts, liquid alts, and where appropriate, other alternatives to smooth out and get a solid long-term return.
Yeah.
So Greg, you just kind of talked, different portfolios for different circumstances, right? Based off income, based off liquidity needs, based off age. So maybe take a minute and kind of talk about kind of your ability to create customized portfolios, right? Like just because someone might come over and they're 50 years old, worth $3 million and need X amount to live, and then their twin brother comes over in the same profile, would they get the exact same type of portfolio?
Typically, no. At the onset, what we do is try to engage with the client and get a sense of who they are. Certain strategies resonate more with some people versus others. And some people, look, everybody comes to their investing experience with biases. Some people have had a very favorable experience with technology. Other people are big believers in healthcare. And we can include those sort of preferences along with the client's portfolio, or there are sometimes some thou shalt nots. Some people don't want energy, particularly fossil fuels, included in a portfolio. There may be, sin stocks sometimes are not um, uh, things that people want to include, and we can make those adjustments as well. But for the most part, where things differ has to do with risk, liquidity, objective. Two twins might have totally different objectives and time horizons depending on what they're trying to do. They might be saving for, a second home in a 10-year time horizon and a retirement in a 20-year time horizon. And his twin brother or his twin sister might have an objective of college education where the other one doesn't. And you have to take all of those factors into account when you're developing a portfolio.
Absolutely. And that was kind of why I asked that question, because I knew the answer, so everyone gets, with you a customized portfolio. So a follow-up question that someone might be saying, well, how can you do that, right? What type of technology, what type of research are you able to provide to be able to have custom portfolios for all of your clients?
Yeah, so we're very fortunate in that we have a full-time data scientist. We have people that are involved just in research. We have very sophisticated portfolio management systems that integrate directly with the custodian we use, which is Schwab. And as we're, in that initial stage and we're building out a portfolio, we at the very beginning stages start to tweak it so that what we're intending to do resonates with that particular client. And then as we're building out that model, we then compare it and overlay it on the client's account, whether they come in with assets or whether it starts with fresh cash. And then we start to build it out over time. And things also evolve. People's experiences change, their preferences sort of change. You know, um, Different industries go in and out of favor. A lot of that may depend on who's in the White House, because certain industries might be favored and others might not. And so we have to be tactical within our allocations and dovetail them with what a specific client wants.
Right. Yes. So kind of the bottom line of that is, everyone can get their own custom portfolio. And even if you've been managing your own assets for a period of time and you're really into one or two different funds or stocks, that doesn't mean that you have to give that up by working with someone else, right?
I think that's a great point. It's frequent that clients will come in with a couple of positions or funds, and they may say, you know what, I don't mind having a diversified portfolio, but I really like this particular company and don't boot it out. And we're not like other firms where you show up with assets and we immediately say, well, this isn't on our list, so it's gone.
Right.
If you have a preference for certain stocks, funds that you've held, we can work around them. We may suggest strategies to diversify over time away from it or risk manage that portfolio position if it's a highly concentrated position. But again, that's just part of the customization and the process that we have with the client engagement.
Right. And you kind of hit on that customization you get by working with a boutique, wealth advisory firm. You have the ability to be able to do that.
For sure.
So before we kind of move to the next topic, is there anything else that you'd like to share kind of on the IPAM philosophy, anything on IPAM's history, anything that you think would be important?
Sure. Mickey had alluded to the firm was founded by my father, and he sort of cut his teeth on Wall Street as a value investor. We've developed the firm over time to be what I call GARP, growth at a reasonable price and value. So our sweet spot really is large cap U.S. stocks, large cap Europe developed market stocks, and then we round out those strategies that we're very familiar um, with other firms that do certain things that we believe can help diversify a portfolio, but we don't attempt them on our own. So if we were to add, I'm just picking an asset class, emerging markets, we don't have feet on the street in China or Russia or uh,
You don't?
no. So the best way to do that is to find the best candidate within that asset class. So if we have conviction about an asset class, that is not something we're going to do on our own. It's something where we're going to use a candidate investment inside of a diversified portfolio to do it. So it's a way for us to stick to our knitting, but also diversify a portfolio and include asset classes that aren't ones where we directly manage them.
Right. Okay, so
And we've been at this for decades, and I've been with the firm this coming month 26 years.
perfect. Yeah. So but the takeaway from that is, between RFS, it's a multi-generational firm. Same thing with IPAM, between the experience between both firms is, we're over hundreds of years here.
Most of
So,
them really with Mickey, though, let's face it.
so let's get to the burning questions that are on everyone's mind, right? Which I'm sure you're going to be able to tell us, Greg, of what's going to happen in the market, right? We're kind of in some volatile situation right now with it being an election year. Yesterday there was interest rate cuts. So give us your crystal ball of where you think the market's going based on different economic factors.
Well, I don't mean to be a wet blanket, but I will say that the market has had a phenomenal return the last few years. Uh, I'm more confident than ever in our strategy of diversification because I think that over time, the asset classes that have brought us here may not work as well going forward. So it's not taking anything away from large cap growth US. And it still might be a great performer over the next 1, 3, 5, 10 years. But when you get very dramatic performance in one asset class, it tends to regress to the mean, and then other ones tend to work that have been lagging tend to sort of catch up. So where the market is going, if we're talking about the market being the S&P, the S&P to me seems like it's fairly valued, maybe ahead of itself a bit. It's in the 90th percentile of valuation relative to its historic traditional metrics. So we're trading at 21 times forward earnings in the S&P. Over a very long period of time, it tends to trade in the high teens. So that if we were to regress to the mean, it would be a pretty significant move to the downside. So it doesn't mean that the market can't continue to rally from here. It doesn't mean that the market can't continue the next 1, 3, 5 years to really give you dramatically outsized returns. But the likelihood of it continuing the way it has the past 2 years tends to go down. The better it does, I think of it almost like a house right now in your neighborhood. Anybody who's buying at the top of this current real estate market probably won't have the same return as somebody who bought during the financial crisis. It's just math. So our duty now is to build out portfolios with things that maybe haven't done as well that might catch up, so that you again try to get that smoother ride. So you're asking about the market and what I think. I think that the traditional U.S. Large cap market that's been such a great performer will probably continue to churn out good returns, but I think you're going to have to diversify into other asset classes to get a decent long-term return. That's my 2-minute take.
And
There's
that
some
lines up
slides
with your
about this as we head down, and maybe I can just delve really quickly into why I believe that.
Yeah.
So and we can talk about the interest rate cut as well while we're on the topic. But if you look at global GDP projections for the next year, they are still going to potentially grow. This is according to the IMF, that you're going to see developed markets probably continue to have positive GDP growth. But what you will notice from this particular chart is that it's somewhat slowing. So while you had 2.6% GDP growth in advanced economies in 2022. It's a little lower in 2023 and even a lower, so we're talking about like, 1 to 2% GDP growth, which on a nominal basis is decent, but on an inflation adjusted basis is basically almost zero. So one of the reasons that we look at things like this is that it tells a story. So if we go down to the next slide, so you're seeing that the inflation rate, which on an annualized basis in June 2022 was as high as 9.1%. There are a lot of reasons behind that. Some of it was energy related, and and then we had, candidly, we printed $6 trillion during COVID, and that flowed through into the economy and created a lot of inflation. But the fact that it is falling so rapidly is telling a different story to me. We're getting down to that 2% target the Fed has, which is why the Fed felt that it had justification to cut rates by 50 basis points yesterday. But what's under the hood? Let's go down a little bit further and delve into the employment picture in the United States. I can talk about the national debt a different time, but it'll give you nightmares. The unemployment picture is weakening. And if you look at some of the earnings that came through this past quarter, on the one hand, you have certain companies that knocked it out of the park, but there were other companies, particularly ones that were consumer oriented, and particularly at the lower end of the consumer area, that came in and really told the story of, whoa, things could be slowing down. So while unemployment was 3.6% about a year ago, we're at 4.2%, projected to be even higher going forward. And that ultimately has an impact on the economy. And the economy tends to be highly correlated with the stock market. So, what's in store for the stock market? Well, I think that I've already talked about the stock market. I'd like to talk a second about the bond market. One of the things that is the benefit of having a diversified portfolio is that if you're using income-oriented strategies, be they dividend-paying stocks or bonds or other income-producing strategies, in an environment where rates get cut, they tend to move up. So if you're diversifying your portfolio with some of the strategies I've discussed, you might just find that if the market comes down next year in those certain asset classes, it might be moving up in others, and particularly bonds. After doing so poorly for 2 years, we're starting to see a lift. And the dirty little secret is that bonds over a 12-month period have produced about an 8% return in the Barclays Ag after having a negative return for 2 straight years, which almost never happens. So again, looking under the hood, bonds as part of a total return, a diversified portfolio. A lot of people have said, dismissed bonds as a diversifier or an income or a return generator. Not so. In an environment like this, your bonds might be among your best performers, and they shouldn't be thrown out with the bathwater. So I've sort of shown in here a couple of different slides. I'll make this presentation available afterwards for anybody who's interested. But the yield curve tends to invert before there's a recession, and then it starts to move back to a flat line before the recession actually hits. I'm not here to say that there's necessarily going to be a recession. Maybe the Fed will stick the landing and we'll have what they call a soft landing. But if we look at history, this particular chart that you have up is a super interesting one to us. It wasn't until let's look at you can go to the ones that maybe you'll remember more recently, like the year 2000, the yield curve inverted, and then we had those horrible stock market years of 2001, 2002, and the first quarter of 2003. But the yield curve inversion wasn't the thing that caused the market to go down initially. It took some time for that to churn through to the economy to have a recession, and for the market to do badly and then recover. So if I'm just, putting on my risk management hat, I'm looking at a couple of different periods where that's happened. So we have 2008 same dynamic. Yield curve inverted. It wasn't immediate, but eventually we had a correction. Pretty dramatic one, if everybody remembers. Um, and then now we had a huge yield curve inversion more recently because interest rates on the short end went up so fast. Okay, now it's getting back to the flat line. That means one of two things. Either that this landing is going to get stuck, or we could be heading into a period where the economy softens, maybe earnings don't come through as predicted, and you're going to need a diversified portfolio to help you get through a choppier time. That's where we come in. I'm sort of all over the map, but I could, and this chart's kind of interesting. This was a survey that was done of 27 economists and market thought leaders. And you'll notice that the market is pricing in even more cuts going forward than even the pundits think will happen. So the pundits only thought yesterday we're going to get a 25 basis cut. He surprised with a 50 basis point, and then gave some language that we might have 50 basis points more by the end of the year. So that to me sort of connotes that the Fed is seeing that things are softening and they have to act quicker than maybe they originally anticipated. Again, playing towards the theory for us that you got to have those diversifiers in there. You have to have your fixed income as part of your overall picture. If you're relying just on the stock market and it doesn't work out the way you want to, and you're trying again, so we're trying to plan, let's say somebody's 2 years from retirement or 3, and the market regresses to the mean and you get a 20% correction. Well, if you were going to retire in 2 years and you have 2 years of a bad stock market, you just extended the time you have to work. That's time for us to maybe take a look and potentially risk adjust your portfolio to take into account. We got to be realistic about where the market is relative to its valuation and what's coming up.
Right. All great points.
So I have a bunch of takeaways in here that, and I don't mean to spook anybody because it might not, a recession and a correction may not happen. I've been at this long enough to know that, that yield curve inversions have predicted, I think it's, 20 of the last 10 recessions. Like it's not a perfect indicator, but virtually every recession has started with a yield curve inversion. It doesn't necessarily always mean it will, but they tend, right. but it's almost always does happen in advance. So earnings are still coming in strong, particularly in tech. Interest sensitive asset classes tend to do better when you have a loosening bias from the Fed. We favor dividend paying stocks and dividend paying strategies and income producing strategies as diversifiers. You don't throw your bonds out. Don't go 100% to equities if you don't have the risk tolerance for it. Stick to certain sectors of the market that you think are going to grow over time. AI and innovation have certainly sort of borne that out, but they're not the only sectors that we think are going to do well over the long haul. So you have to make sure you're not just have all the eggs in one basket, as it were. And balance and diversification are the key. And I really didn't talk about some of the risks, but I should touch on them because there are some pretty dramatic ones out there. And it's not just potential for recession, but the geopolitical concerns to our way of thinking are not priced into the market right now. The market is sort of merrily going along its way, but not taking into account a lot, the conflict in the Middle East that could escalate. The Ukraine is still not resolved. China and Taiwan continue to butt heads. North Korea still rattles its saber. So it's not a risk-free world. And the volatility index is not necessarily telling we think the right story currently, that the world is a dangerous place, and we have to be just cognizant of it. Market breadth is improving a bit, but earnings are still, and the market returns are still highly concentrated in just a couple of different stocks and a couple of different sectors. We could have a recession. And candidly, a Fed loosening sometimes, if it reignites animal spirits and certain asset classes like commodities go up, you wind up with inflation all over again. So you have to be careful on that front too, that just because the Fed has said it's going to start cutting rates, if inflation comes back, they're going to have to maybe reverse course. That would be very unwelcome and would be a catalyst for things to regress back to the mean, as I was mentioning. China has its issues with overvaluation in its own economy. And then we have the election, which I could go into for an hour or two if you'd let me, and I'm sure you won't.
Right.
I think I've maybe touched on enough issues, but anybody who is on this call or listens to this, who has subsequent questions or wants us to take a look at their portfolio and evaluate, I would encourage you to get in touch with Mickey or Michelle or Stuart or Mark and set up a Zoom call, because we'd be happy to speak about all these topics in more detail. And thanks for the opportunity.
Yeah, so Greg, that was great, because it was actually a question that came in that, okay, if someone has an account that they say, okay, like, what would be the first step just to have you review it and get your insight on it, which you kind of just touched on.
Yeah, we're again fortunate from the relationships we have through, because while we have a really solid team, we also get data and analytics from large firms, and those are Goldman Sachs and JP Morgan and BlackRock, and others. And we use those tools to help us to analyze existing portfolios and our own portfolios, and to risk test them. And so if somebody is interested in that sort of output, we would take a look at that portfolio, put it through some of the software and analytics that we have, and then review it with a client and say, hey, by the way, did you know that you own you own 4 mutual funds, and those 4 mutual funds own the exact same stocks 4 different times, and you think you're diversified, but you're not. Like, we can uncover that sort of stuff.
Right. Or, and I've seen that output, showing the comparison of how much risk they're taking versus how much risk they thought they were taking, right?
That happens very frequently.
Right. And then how you can show them with the diversified portfolio, likely you could almost project a similar type of return, but taking a point or two off the risk, and that's ultimately what everyone's goal is. Like, as human beings, we want the most, right? But without taking the most amount of risk,
Yeah, there's no silver bullet for that, but this data is super helpful for an advisor like us to use a thinking man or thinking woman's approach to what would a reasonable person do who's trying to accomplish this objective in this amount of years, who's willing to take this amount of risk. And particularly for folks who have portfolios where they've set it and forget it, they
Right.
tend not to have looked at this stuff in maybe 1, 2, 3, 5, 10 years, and don't even know what they own anymore. Those are the folks that I think that we tend to be able to help the most.
Right. And that was the point I was actually going to make, is that working with you, you're no longer going to be in that set it and forget it stage, right? Because you have someone actively managing it, and you're going to reach out to them, right? And say, hey, let's talk about this. Like, years aren't going to go by without you reviewing their account.
Yeah, and as we're building out our 2025 models right now, the things that we've had a tactical tilt towards for 2023 and 2024 are not going to be exactly the same because of some of the reasons that I just told you. So within our bond piece, within our alts piece, within our equity piece, all of that is going to be modified and then superimposed over the specific client engagements that we have to make sure that what the customization that we've built out for them is honored.
Absolutely. All right. So we appreciate your insight, appreciate your time there. And for everyone listening, at any time that you're listening to this, if you want to set up a call, reach out to Mickey, reach out to myself, reach out to Stuart. We can just start with having a conversation with Greg about learning more about their philosophy, sharing what your situation is, and then kind of taking it from there and doing that comparison, and seeing if it makes sense. And it could be qualified money, it could be non-qualified money. Everything, has a different place into someone's financial picture that we can help with.
I'd say people tend not to do this when the markets are good because they feel like, why bother? And then when the markets are bad, they say, oh, geez, maybe I should have somebody take a look at it. I usually find the right time to look at it is before.
Right, right, right. Right, Vicky, anything you would like to add?
No, it's been a long day. I want to thank everybody that listened in, and as Michelle said earlier, since it's a tape session, it'll be added to our website, so you can either review it another time or invite a colleague or a friend, go onto our website. You can view any of the seminars from this year. Greg, I know we at RFS made the right decision in partnering with your firm. You've proven it, and we welcome the future together.
Yeah, we're extremely excited about this relationship, and I can't say enough good things.
Same.
Okay.
All right, everyone. Well, let's adjourn for this evening. We thank you for your time and enjoy the rest of your night.
Thanks much.
Take care.
Good night.